Alright, hello guys, glad to have you on board again today. You might have noticed last week fell down as I wasn't able to record due to some audio settings in this new working environment which I just moved into. Nevertheless, we're going to recover stuff as they used to be regarding those weekly updates, and this one is going to go exactly catching up on the latest 2 weeks. So if I remember correctly, the last time we talked to each other we had this kind of 4-hour kind of setup in which we were building an additional 5th range boundary by the recording. If you remember correctly, we've assessed the wave count to be this one, like 1, 2, 3, 4, as there was the delayed 3rd range boundary, and as we retraced back up, creating therefore the 5th range boundary, we had opportunity to trade it. The opportunity in here was to use the actual dumb strategy, and therefore just to cool down, not overthink things, forget about all psychological investments and involvements, don't listen to the news flow or anything like that, just blindly and stupidly trade the top of this range with the signals according. The signals were pretty weak, reason why we said the trade is still definitely viable, but you should eventually consider not going full force with that trade and have a maximum target at the mid of the range, which is exactly what we've gone to, retracing to the moving average. The average context and the 50% Fibonacci line were all standing in this area, and this is precisely where I had my taking profits executed. So if you've taken this trade, remember, small position sizing according to the risk management that we had back in the time, and it's been, to my at least personal trading, a profitable experience. Now, question is, what's going to happen now on? Remember, we've also assessed, if I'm correct, that the risk were to reverse the actual daily context in the process. And that's exactly now what has happened effectively at the 1st of September. Remember, the daily context gets updated every month, and that's exactly what we had earlier in September. We've reversed the context visible in here by the turning into this red color here. Now that means we can no longer apply any range strategy, dumb strategy or whatever in the 4-hour reference context, because now the daily chart is our reference chart. So that means if we do wave counts in here, we are exactly at the 3rd range boundary. We're definitely preceded and still going on with a market uptrend, which means we can and we will be able to trade a 3rd range boundary. As you would have noticed, actually we've missed this one because, well, the signals have already been given. We were already overbought inside the resisting context, and by the 2nd of September the actual prices have reacted properly. We also had the ability to collect a range breakout target, which is, to me, a very good kind of risk assessment if we collect all those informations. So that's the kind of trade I was willing to take. So the idea here is I actually couldn't trade that one, but I will definitely take the opportunity right here as we have significantly same prices. So let me rephrase this thing very, very clearly. The idea here, the rate trade was in here, as the fact that if you've missed this day, because for whatever reason you weren't there, the candle closed pretty significantly lower. In these kinds of occurrences, what you can do is, for some time, wait for this kind of retracement back into the original area, which triggered a trade, and get to trade according to this. It's a slightly bit riskier trade, because of course it involves having prior reactions and hoping to get retracements to be able to enter the trade. But nevertheless, to me, the signals are there, and they tell me that we do have, at least currently, the opportunity to trade a bearish 3rd range boundary. This one, as you would have noticed, have barely retraced close to the double top pattern. Nevertheless, the accounts are the reversal happened inside the context, failed to close above it, and could also very well change in the following days. Not to mention the FOMC today, so be very careful with that. Also account for the large stop loss position size that is required in this kind of trade. So right here, right now, you should have a stop loss somewhere around 5,900 if you're willing to take into that daily trade. Also remember that this daily trade can definitely be taken right after the 4-hour one. The 4-hour one has concluded positively, and now we have migrated to another different strategy to a higher time frame beta. So this is really the way I am now, meaning that still ahead of FOMC meeting, I am trading this 3rd range boundary. We're in a range context, and I'm not overthinking things beyond reasonable limits, which means certainly the FOMC can create some volatility, But just by collecting the technical evidence, I have no such proof that I should impact my risk limitation and strategy just for the sake of the FOMC meeting. So I just forget that thing, because that's exactly what a range strategy is supposed to do, and I will blindly and stupidly apply the rules as they are. That tells me I have everything to trade, and I will definitely do it. Now, what's going to happen out of this? Once again, random stuff. You don't know anything about the future, don't try to, and don't listen to anything like news flows or psychological involvement. Don't let yourself being introduced in any other external factor to this strategy. The daily chart now is the reference context if you are trading range strategies. For now on, that's a third range boundary, and if we get to trade it effectively, their target would be to break below the previous low points and close below the actual support context. If and only if we get to neutralize, that requires a daily close to happen above 5,600. And if we do have such a thing, then that's the sign that we have neutralized the third range boundary. And the fact that you've traded the bearish occurrence doesn't change anything to that. You've already taken your trade, the risk assessment has been made, and the market will decide accordingly. The only thing that changes, though, is the actual target. If your third range boundary traded bearish turns out to be neutralized, you need to accordingly change your risk management, which means for now on your new target will be the mid part of the range instead of the bottom of it, and your end target will be to target the bottom of the range instead of targeting below. So that's precisely all that you need to account in the risk management now, ahead of this very unpopular FOMC meeting, to say the least. So this is really all there is. Don't trade the information per se, just look at the chart, and the chart tell you the technical setup is pretty neat. Therefore, you should take it into account and trade if you have the opportunity. So that's exactly what I have done personally. Okay, now that's it for S&P 500. For everyone else who is trading like the flow sequencing, and remember, you can do both in parallel. There's nothing preventing you from doing such a thing. Nevertheless, the conclusions in here are still the same, meaning there is nothing for us to do. We have terminated the third flow. The profit takings have already been triggered. And we're now waiting for the first corrective flow to pull itself, and there should be by the number of 2, which means for now on, no one should be looking to trade the first flow, as it is complicated, and the market consistently keep making higher highs for now and keeps going all-time high as well. So by extending the previous wave, we are still waiting for the moment where the actual resistance context will fall below the flat or falling moving average. Once and only once we got those informations pulled on the charts, we will be able to check mark on the first flow to be in front of us. And by doing this, we will let it play out until the significant retracement happen, and we'll eventually get to expose ourselves to the second flow, if only. And once again, normally we shouldn't even take into account those consecutive corrective flows. We should just let them happen, and once they have terminated and completed the sequence, we can restart to an upside potential, which is in the direction of the major trend for S&P 500. Always remember, corrective can be expressed, can be traded, or risk managed for general type portfolios, but nevertheless, we always follow the major trend, and the major trend from now on is still bullish. So that's it. Now for cryptocurrencies, very quick look at it, but clearly we're going to go straight to conclusion. There's nothing to do out there. Trades should already have been taken in this 4-hour reference context for Bitcoin. Remember, you should have traded the lower Bollinger Band here, and you should just be now waiting until we find strength to break the previous resistance territory, which is standing still at $73,000. And we're far from doing this, and there are no reasons you should move on one direction or the other unless you get either stopped out or validated. Whatever happens in the meantime is none of your concern. And the fact that we have repeated volatility alerts in the chart just tells you that, boy, you should definitely not look into anything like psychology or whatever. The market is volatile by nature, but now on top of this kind of volatile crypto markets, we do have a bunch of actual technical signals confirming the volatility can keep express itself in the following weeks. Ethereum is on a slightly different picture here. As you can see, this one's much more bearish, and the technical signals have now kind of limited the impact of this volatility alert. Remember that all these alerts tend to last for 6 to 7 kind of context boxes, And we are now nearing the end. So we're at the end of the volatility pattern for Ethereum. And for a brief history call in here, we should have bought in here. And I think some of you guys might have taken a stop loss in here if you were using the tight stop strategy and didn't react fast enough to this volatility alert. For those who have been in this kind of scenario, remember that you could decide whether or not you want to enter the trade again. And this time around, putting a larger stop loss. Remember that the maximum stop loss anyway can't be any way further than 1500. So as you would see, that would be somewhat of a pretty cheap stop loss, because entering the trade in here with a maximum stop loss as 1500 would essentially give you a very interesting risk reward just to reach out the validation. So that's something to account. Also remember that now you have much greater kind of price to risk reward opportunity in this kind of trade. Therefore, of course, minimizing the probability of success. So be aware that Ethereum would be a better bet now in terms of risk management strategy. That also means chances of success are, of course, probably limited in here as well. So it's up to you to decide whichever is going to be your favorite. You could actually decide to do both. Also, remember that they do have somewhat of a destiny altogether. There are limited chances to see Bitcoin validating by breaking the top of the range and not seeing Ethereum doing the same. There are still people arguing it differently, and remember, you should not let these people get into your head. Don't listen to the FUD, news flow, whatever. Don't get yourself impacted by anything but the charts. And that being said, I'm going to leave you guys with that. See you next week. Bye-bye.